Good morning, everybody. Welcome to the Flow Show, Tuesday, 6th of February. What have we got going on today? We shall have a look. Morning, Kay. How you doing, mate?
Hey, good morning, Ryan. How is everything going? 1 week to go to Pancake Day.
Yeah, the hot day on our calendar, the first day of the year that's worth something.
Exactly.
Pancake Day. And you haven't even mentioned Valentine's Day, such as the romance.
Pancake is a bit higher at my calendar. At my age, you will see.
You can make a Valentine's Day heart out of pancakes and you kill two birds with one stone. See, look at that. Double and productivity. That's the way we do it here. Right, enough of pancakes, so you got me hungry now. China, what day is Valentine's Day, Bran? Come on, Bran.
The day after Pancake Day, that's the only thing you need to know.
Oh, dearie me, Bran. You got a lot to learn, mate, a lot to learn. Right, China, the big guns are coming out. China Z is going to discuss, or if he hasn't already, the stock market with financial regulators. There's going to be a few hot collars felt amongst those regulators, it seems. Now the big man is stepping in. We've also heard that more from the CRSC, they vowing to punish those behind stock market manipulations. We also heard that the sovereign fund is going to vow to boost ETF holdings as well. A lot of those headlines, many are unsure because we heard about this, what was it, $280 billion that they were going to put into the market a couple of weeks ago, but we've not really heard what they're going to be doing exactly with that money and when. So maybe that's part of the sovereign wealth fund stuff that's going to happen. But still, the market not really seeing anything coming from all this money that they're going to chuck at it. But the news has helped stocks in China stage a bit of a bounce, as you can see there. They had to do something. But let's see if this bounce lasts or whether we get what we had here, which was a bit of a bounce, and then it all headed south again. So again, if you're looking to trade falling markets like this, you want to see it stop falling at the very least. So any retest down here, if it starts holding, maybe around the 5,000 mark on a retest, that would start to indicate we may have a bit of a bottom put in place. But for now, the market is taking that to the bank, those headlines, and we have to see if the proof of the pudding is in the eating, as we like to say. Over in Japan, we had some wage data out, and this is going to start to become pretty important, or rather earnings data coming out. Let's see if I can find it. Go to the right page, if it even has it. There we go. So average cash earnings year on year up 1%, was expected to come in at 1.3, so a little bit softer on expectations. Overall income for employees was up 1% from the prior 0.7%. Overtime pay was was negative, down 0.7%. So things not entirely all going the right way. Household spending, though, looks a bit soft. Month on month down 0.9%, year on year down 2.5%. Among that, the real cash earnings was down 1.9%, was only estimated to fall 1.5%, but it wasn't as bad as last month's minus 2.5%. We have had a bit of news out. Well, Bloomberg had a piece out which Gavin kindly put in our room.
Oi.
Oh, sorry, it was you, mate. Sorry.
Oh, Gavin put it, but I was first.
It's Gavin who usually does it. It must have come in. Right, okay. Just to keep K-Man happy, let's put it on the screen, so we all know what we're talking about there. Let me find it quickly. Oh well, no, not going to do that. I'm going to show you anyway. So Bloomberg put up a story saying about what's happening with the hikes. It was gated, so I found an open copy. In that piece was some key data or some key dates for what's going on with these wage negotiations and whatnot. So here it gives you a list of when the unions are starting their discussions, all the different unions. It goes all the way through February. Then on March 7th, we get the next wage data, which is what we've just shown here. Then March 15th, we get the first tally of pay deals coming from Rengo, which is going to be pretty big. And then then have a second tally and then a third tally. I'm not sure about all the others and when that stuff drops, but this is when, why does it keep flicking off? This is when all the stuff starts happening. So February, end of February, beginning of March, we should get an idea of what's going to be happening with all these wages. Some are looking for 5%, some are looking for 6%. The market is going to have probably a rough estimate somewhere between 4 and 6%. Anything lower is going to be seen as dovish or unhawkish for the BOJ. Everything above 6%, if that happens, is going to be far more hawkish. Kay, we had a bit of focus on this last year, but now we've got some dates to look at. It's going to be an interesting watch. I think the market's going to be cluing up on some of these dates as well. Do you think?
Yeah, very much so. This is going to be one where the yen will probably move before the next Bank of Japan meeting because of those announcements. Those announcements now have the ability to move the markets. We've already had like some days where the market was trying to trade some stuff where they were asking for those big increase, but you can always ask for a 20% increase and only get 3%, right? In all the lot, you see a name that comes back regularly is Rengo. That's going to be the benchmark that the market is probably going to try to hang its hat onto. So those are the ones that we should really pay attention to. I went back to check how much were those exact increases, and I thought it was 3.8. I was pretty actually convinced for 3.8, but it was about 3.6 or so last year. So yeah, 4% is probably a good close enough for government's work measurement or measure point. And that's going to be determining, because that's what the data tells us. That's what the government tells us, you know, that's what they want to achieve, to finally get us out of negative interest rates. Now, the thing is as well, it's Bank of Japan, where they're going to take us out of negative interest rates, I reckon, regardless, because of CPI still. But if they get good news on this one, that is going to give us, I think, second indication on not how far they can take it, because we know that windows open and close relatively rapidly, and they did not take advantage of a very wide open window for a year and a half now. But depending on those wages, it might give us an indication whether the bank can continue to hike regularly. If it's disappointing, we're probably gonna get out of the negative interest rate policy, getting perhaps 1 or 2/4% hikes, and that may be it. If we get like really good wages, that is going to encourage them to go a bit further. And so in short, the higher the wages agreements, the better that the Bank of Japan has a chance to take rates a little bit higher.
Yeah, very much so. I think we're at the stage now. We've been following this long enough. It's now finally we need to line up the ducks in a row to know what's happening. So this is duck number one, getting these wage numbers out. Once we get those, if they're good enough, say they're above 4%, 5% mark, then the market is going to go, yep, the BOJ are going to end negative rates. That's likely to bring a yen move, as Kay said. Then we need to, the next duck is going to be, well, what's inflation doing? Is it creeping back up, or is it still knocking around the target? Because that may take a bit of hawkishness out of the BOJ if they're worried that inflation isn't going to rise. So that's going to be important too. They could use that as a bit of a counter to stop the market getting too hawkish. Then 3, what they're going to do with rates, as Kay says? Are they just going to end negative rates and then take it slow and steady, or are they going to indicate they're now on a hike cycle and how big that hike cycle might be? Once we get all that, then the majority of the moves, or the big moves, are likely to be over. So we're going to get a big reaction on these wages. We're going to get a confirmation reaction on the BOJ if they finally decide to end negative rates, and what they decide to do thereafter. Then after that, it's going to be a case of how hawkish it's been or not, and that will define what moves do after. But yeah, as we've been saying before, probably the bulk of the move is going to come once we get all this bits falling into place, rather than what's going to happen on the decision.
Yeah, I think if you look at the calendar, there's two dates there which are pretty important. It's the March 18-19 Bank of Japan policy meeting, and the Rengo's second tally right after. I know we have the first just before, but it may be a bit soon for the Bank of Japan to do something in March. Also, we have to bear in mind that March is the last month of the fiscal year in Japan, and I'm not now. Okay, there's always a percentage chance, of course, that they do something, and we are not like in the shoes of the Bank of Japan either. We don't know for sure. But my base case is it's going to be for April, the decision, because March, in the middle of the end of the fiscal year, before Rengo releases the second tally, which is probably going to have a bit more numbers crunched into it. That and then on the 4th of April they release the third tally. We start the new fiscal year in Japan. Bank of Japan policy meeting plus I think they have their outlook, and it's an important meeting, always the first meeting of the new fiscal year, and I think that's where things are going to happen in Japan. I would personally say that the 18-19 of March would be a surprise if they move already there.
Yeah. No, I think I agree with you on that one. It will be difficult if this first tally comes out something like 6%. The market's going to go wallop for that March meeting, because that first tally is 3 days before. Yeah, but right, they do get the full information. They get the third tally before the April meeting, so it could set us up for some good trading. If the market's all bullish there and they don't change policy, then you're going to see dollar yen pairs rally, and then that might be something to hit. So to run into April, but yeah, it's going to be spicy. But here we are.
Exactly.
We've been waiting long enough, and we could be at crunch time, and it's going to be historical. So remember where you were on those days. Take a photo, because this is history potentially in the making.
For no matter how long we trade, I will, if unless I make a mistake, I did not see any Japanese rate hikes.
No,
I don't think that they ever hiked, or perhaps early 80s also, or that's possible. But from the 90s, they've only done one thing: is cutting rates, if I recall correctly.
Yeah, so see, that's how historical it is. Even Cayman hasn't seen a rate hike from the BOJ.
Yeah.
So it's going to be big, folks. We've been waiting long enough, and we could soon be there. Right. Anyway, let's move on, because there's plenty to happen until then. We have had Ueda coming out anyway. Last night, he said that they have time to reach a decision on their ETF holdings, and they're going to decide the fate of ETF buying if the price target is within sight. So again, similar to what we've heard from other central banks, they're not going to wait for the target to be hit or tapped. Just being in the ballpark is going to be good enough. So it means that the BOJ, again, we don't need to see inflation at target for them to pull the trigger, as long as they see it going the right way. Right, over to, sorry, mate.
Yeah, if I may just say something on those ETFs. Imagine Bank of Japan starts to raise rates. It should have in the first instance a negative impact on the Nikkei. I mean, just per correlation. the thing is that my personal view is that they will stop. They've already stopped actually, buying ETFs.
Yeah.
When Nikkei goes up, they don't need to buy ETFs, right? They really stopped it. They haven't been buying for a very long time, and if they did, it's like really I don't know. No, I don't think they've actually bought any ETFs for since the beta has come on. It's a formality to stop buying and to officially stop buying because they can start again if the Nikkei collapses back to 20,000. But the selling any would perhaps take much longer because they will want to see how the asset markets react once they start to normalize, and they will very likely not start to sell ETF anytime soon. Anytime soon.
Yeah, that's all going to form part of the tightening process. QT, all that. Reducing the balance sheet. That's a whole big issue to come as well, isn't it? Because it's absolutely massive. Over half the bond market they own. So
Yeah,
that's something.
That's
But
something.
they could play the long game. Same we said, they could play the long game on that. They could just let it roll off, let it all expire, and get rid of it that way, and it will take another 30 years. But they're not averse to 30-year timelines over there.
No, that's true.
And I guess that might be the other trade. If the market gets overly hawkish on the BOJ and pushes yen too far, a bit like we've seen with the rate cuts and the Fed. The market always likes to go too far on something. So after the confirmation, that's one trade to potentially look at. Will the market go too far to the hawk side for them?
Yeah.
But and we shouldn't rule out that if they don't do anything, if they don't see the conditions right, well, you're probably getting dollar yen up to 160 or something, even if not more.
I don't think that's actually realistic. I mean, that would be with 0.01% probability right now. If they really don't, they have to. They really have to, right? I mean, it's impossible that they won't do anything at all. That's impossible to me, at least.
Yeah, but even 0.1% is still a chance, so we have to keep it in the back of our mind. So never rule out anything. Right, going across the water a little bit. Aussie retail sales came out and were a bit sucky, down 2.7% on the month. Quarterly numbers, though, looking a bit better, but not looking too hot, that monthly number there. The RBA, they kept their rate unchanged, 4.35% as expected. Both GDP and CPI forecasts went down over this year and next year. Unemployment rate expectations went up. In the statement, the RBA said that further increase in interest rates can't be ruled out. That's a line they've had in there for a while. They're not quite like the other central banks to pull that line from their statement. So they're going to keep their doors open for that. I said inflation is to fall a little faster than previously thought due to goods, but service inflation is still high. I mentioned China, saying the Chinese economy is likely to slow in the year ahead and global growth is seen as soft. RBA's Bullock, in her presser, said that progress has been made on inflation, but the job is not done. They're not ruling anything in or out in terms of policy. The central bank is driven by the data, not market pricing. Said that November hike was not a mistake. It sounds like she got questioned on that one. She says the rate risks are seen as finely balanced, and then to steal the same lines from all the other central banks, as rate cuts need confidence. CPI is sustainably hitting 2.5%. Anything you picked up from the RBA? It all seems
noise,
much as expected, really.
Yeah, exactly. I mean, noise. I think the market just went like work to do. Oh yes, we are a bit short Aussie. Let's buy it back, but we are still turning around those levels. But then again, that 25-40 zone there. We've been talking in length in our room about that level as well, and on all the shows and. It's capped for now. It's a bit of the original break zone. Yeah, I mean, got the 61.8 at bang at the 65 the figure. Giving back up 65 the figure may actually be significant enough already. I do think this is much more short-term traders getting stopped out of fragile shorts on the break of 65. But the fact that we are below 65, 25, 40, to me that says relatively enough. And not even for the direction necessarily in the medium term or so, but just the reaction on the central bank. I didn't see anything new in there. It's really she and her crew. They just went on probably on data dependency, just like the rest like the rest of us, right?
Yeah, very much so.
Yeah, I didn't see a trade in the RBA. Wouldn't it be for selling the rally up to the resistance zone, for instance? But there wasn't for me. There wasn't enough in the RBA to initiate positions, so to speak.
Yeah, no, I get you. I wasn't awake for it either. So, yeah, I was tempted to put a bit of a short on Aussie dollar yesterday. I was getting a bit of a twitch on it because it would seem to be holding up a bit better than the others. But then I thought, well, we've done some miles in those, so maybe we'll get a bit of a bounce. And it looks like we did, obviously. But anyway, yeah, bit of a dead cat bounce at the moment. And we're now getting back under 65. So, yeah. Going to be interesting to see if we hit this 85 area again and bounce from there. That might indicate we've got a bit of a low in place, temporary or otherwise. So that's going to be my key watch for this one now. If it carves through there and then goes through the low, then yeah, we're continuing on with this dollar bullishness, particularly against the Aussie. But yeah, it's for me. I don't know if you had any levels there, but I had nothing round about where it did bottom out. It couldn't quite get down to my next level, 64.50. As you can see there, a bit of a S&R zone down there. That's going to be the next support point for me. And then down to 64s, which is a big old historical level as well. So, yeah, I don't know if you had anything else down there, Kay, around that area.
Let me have a quick look. I was not on the Aussie. 64 the figure.
Yeah.
64 the figure to me is a big enough, well, interesting enough level. A few spikes, 78.6 of the October or yeah, the late October December move into the end of the year. 64 the figure. That's I think my next really decent level.
Yeah, cool. That tallies up. Always like it when that happens. Right, let's crack on then. BOE's appeal says the pickup in GDP isn't going to be dramatic. So just when you thought you could get a bit excited about the UK, the glass half empty man pops up to burst your bubble. It says you're not yet confident in inflation to reduce rates. So again, that line, not yet confident about inflation. German finance minister came out yesterday saying that German growth remains weak and thus they cannot give forecasts yet. It's that bad, the economy over there, that they've stopped giving forecasts. Well, you might have got a bit of a shot in the arm this morning because we had some German factory orders. Look at that, 8.9%. Everyone cheers. Germany is saved. Not quite so. The reason that jumped so much was because of some airline manufacturing and purchases, big ticket items in those numbers. If you strip out those big ticket items, factory orders fell by 2.2% on the month. So still a negative number. They got saved by some big business, which is all good, don't get me wrong, but that sort of business doesn't last for too long. So things aren't as good as the green numbers suggest there.
Mm-hmm. Yeah, but we all buy a plane now and then, no? Don't we?
Yeah, we've got. Have we got one in the fleet?
We got one in the fleet, in the flow fleet.
In the flow fleet, yeah, with our submarine that's parked in Lake Garda. Pretty useless being there, can't get out. Anyway, so yeah, just when you thought things looked good, not so good in the end. ECB are running their 1 year, their inflation expectations survey. Is this a new thing, Kay? I don't remember this popping up every month.
Every month or every quarter?
No, it's every month now, it seems.
Oh, no, it must be new then. I didn't see a monthly report before either. Quarterly, yes, but perhaps they changed it then. No, I don't recall it either.
Yeah, it's not. Is it on the calendars? They started putting it on the calendars. No, they haven't even bothered putting it on the calendars. But yeah, we had it last month, and it's this month as well. So anyway, they're doing a survey monthly now on consumer expectations for inflation. The 1 year number came in at 3.2%, which was unchanged over last month, but that got revised up to 3.5%. So effectively, it makes this month a drop. 3 year expectations came in at 2.5%. That was higher than the prior 2.2%, I think, but that was revised up as well to 2.4%. So that one still went up. Overall, 3.2 1 year, 2.5 3 year, still well above the ECB's target. And expectations are a big theme in terms of their monetary policy decisions. If the expectations are down around target, that would push them closer to a rate cut, even if the actual numbers, the hard numbers, weren't at those levels yet. Retail sales came in suckier than expected. Month on month, down 1.1% versus minus 0.9 expected. Year on year, a little better than expected, but still a negative. So that all the positive numbers from last month, that huge 0.3% lift, which was a higher revision, fell out of bed in December. ECB's DeCoste says he's now confident inflation is moving back to targets. There's a kiss of death for you. He says the ECB follows its own assessment, not market expectations, which is why they've got themselves in so much crap over the last few years. It says the ECB is confident the next move will be a rate cut. Let's wait and see, shall we? Right, yesterday's data from the US. We had more of the services stuff popping out. First of all, the final S&P number just came in a little bit worse than the flash number, 52.3, but still a gain on last month. And then the ISM blew the bloody doors off. A nice strong number coming in from that. 53.4 versus 52 expected, up from the 50.5. A big jump in employment, which was in the negative at 43.8, a huge drop, remember, last month. Wasn't expected to move into expansion, but did, 50.5. And then this number, prices paid, prices paid, 64, up from 57.4. So this is the inflation numbers. This is how much it's costing firms to purchase their goods that they then sell on. So a huge jump in that number. So more Goldilocks data for the Fed, but wrong numbers for the inflation picture. And it's just another little thing that's falling into place now. We saw higher wages in the NFP. Now we're seeing a jump in prices paid in this one. So it just feels like there's some inflationary pressures building, Kay, at the moment. May not lead to anything, but it seems like stuff's not going down.
Yeah, those numbers are very strong. I mean, it's undeniable. The what we had on Friday yesterday, and then apparently on Friday as well, and I overlooked that, and that number gets revised 100 times. But Atlanta now, Fed now, or whatever, they was also revised higher for the GDP. Yeah, those numbers are really keeping the Fed a bit prisoner, I would say, and also the market. The market also is a bit prisoner now. And I'd love to say, let's see what the next month's data are telling us, because once we get out of this over the turn of the year, up and down in seasonalities and all of that, perhaps we could have a clearer picture then about a trend also. But in the meantime, those numbers are there, and the market is visibly trading them because the dollar is underpinned. Despite the stock markets remaining quite high as well. I think correlation algos, higher stocks, weaker dollar are not having a very fun time right now. Yeah, I think that's those are numbers to really not ignore right now, and we will see the next month if it turns around again.
Yeah, absolutely. But I'm just getting that little spidey sense tingling again when it feels like something's changing. You know, we saw in the Eurozone PMIs, pretty much I went through all of them. All of them cited wages as higher input costs as amongst other things. It just seems like things have just turned a bit, but it has to translate into the hard data. So, yeah, one to keep an eye on for the weeks ahead. Fed's Goolsbee says that he doesn't want to rule out a March cut. We need to see more data showing inflation progress, and said he won't speculate on the potential for 50 BP cuts when they start cutting. A little bit of a dovish tilt there than many would expect in terms of what the Fed may do. Fed's Bostic says wage growth is settling back into more normal patterns. Well, maybe he didn't see the NFP stats last week on those. Fed's Cash and Carry says possibly higher neutral rate means the Fed can take more time to assess upcoming data before beginning rate cuts with less risk to the recovery. So he's in the higher for longer camp and no need to rush into cuts. The Fed was out with its January Senior Loan Officer Survey, which surveys the banks and financial institutions to do with credit, what demand's like. And the overall summary of it was that there's tighter standards and weaker demand. Tighter standards means that you've got to jump through a few more hoops if you want to borrow money. That's the bank thinking that rate hikes will put additional pressure on people's firms' abilities to pay back loans. So they're going to make sure they dot the I's and cross the T's and ask a few more questions before they start lending. But that lending was seen as weaker in January anyway. So again, those tight financial conditions playing their role in that. Right, I think that's it that I've got. Kay, anything floating your boat?
More than enough for one day.
Enough. Good. We can move on. Ali, you're trading away again, I see. Short in gold. A long-term trade? I don't know. You got a 2025 entry and a 14 pip stop. Doesn't seem like long-term to me, mate. And then you got an 8-tick target as well on that. Well, let's have a quick look at gold, shall we? I was looking to see yesterday if we got to move down to this 2010, 2000 area, maybe to try a bit of a long, because I think there's still upside for gold, or there's still a bid under gold while we've all got this geopolitical risk going on. So I was looking to see if this dollar strength maybe kicked us down into this zone where I was going to try a little long, but no. Maybe if we're seeing dollar picking up again today, we'll have another look. But the bounce looks very weak at the moment. Couldn't even get into the 30s where we've sat for quite a long time. So you could be on the right side for this, mate. Certainly, well, you only need another 5 pips, 6 pips, and you're there. So good luck with that one. As for the rest, I was sitting in the chat room this morning. It seemed a case of the nearlies. Yesterday we nearly got down to the big figure in that fib in euro dollar, but couldn't. We're on our way back towards those lows now, so that's what we need to be watching initially. Now if we get through that low, then all this move is going to continue, and then we'll see what happens down here. We're probably likely to get a test of this area here, and I want to see if that's a road too far for this move, which has lasted since the new year. I'm tempted to maybe get my fishing rod out down here, but as I'm at the moment seemingly going long euro dollar, looks like pissing into the wind, I shall respect that and maybe keep the trade a little bit smaller than normal. Dollar yen keeps banging its head up here at the 148.80s. We had a little nudge through yesterday, couldn't get through, dip back. We're having another go now. 75's trading. We keep coming back and knocking on the door. See, it's different price action here to what we've had in these prior tests where we nick up, get knocked back. This looks more like it's building for a break. So if you're looking at shorts, if you've been shorting up here against this level, be very careful now. We keep coming back. We keep knocking on the door. The moves away from this level are just the lows are going higher. So just be wary that we might get a break through that level. Cable as well, just mooched through the 38.2 fib. I mean, I've had to redraw this fib enough times. Can call it a hold, depends on spreads and whatnot. But again, looking for a move to 125 for maybe picking up a bit. But that didn't happen. Again, another case of the Nearlies. So we haven't really had a proper retest back up to 126 to see if this broken level is going to hold, and that would indicate we're going to get further downside and maybe just set up a new range. Maybe we hit 126, that holds as resistance, and we have a move down to 124.5, 124. So maybe we just form a little range. I still don't see a reason why the dollar should really go massive. Yeah, we've broken the ranges. Yeah, euro dollar's been weak for a while, but I don't see anything that will take cable to 120 or anything like that. At least in the short term, we're not pricing in a change from cuts to hikes for the Fed. We're just the market finally realizing again that early cuts are not going to happen, and that the US is doing pretty well. So doesn't mean we can't move down here, but it's going to be a case of watching the data over the months. Is the gap going to widen between US and other economies, UK, Eurozone, whoever? If that happens, then the trend of dollar strength is going to continue because the US is going to come out on top. But from here, I'm not expecting any sort of collapse in these sort of pairs. If that's not a kiss of death, I don't know what is. Aussie dollar we spoke about, euro sterling. Now, again, I spoke about this one time and time again. If you want to catch knives, you've got to look for the right price action. We had price action here, hit a solid level, couldn't get through the level over time, then we get a bounce. The same things happened here. We hit a level, we made a new low through that level. Straight after, we held the old level, held it. Now we've had a bit of a takeoff. Okay, this is what you want to watch. Catching a knife doesn't work here. Make a low, you break the low. Make a low, you break the low. Make a low, you break the low. That's not indicative of what you want to see from price action. This is what you want to see. So sometimes it's worth just sitting on your hands, letting the price do its thing before you get the butcher's gloves on and try to pick it up. Unfortunately, I never got my entries in. I was parked up 85.05s, so I've done nothing. We've had a bounce, got through the 50 level on this bounce, which was a bit of an on-off level, as you can see. But in this bounce, it went straight through. We hit another sort of intermediate level, 85.70. That's marked the top for now. So maybe 50s is going to show up again. We're here close enough at the moment. We shall see. But if we come back down here pretty quickly, then that might suggest we're on for a break because the bounce would look very dead cattish. However, that's what euro sterling can do. So we can sit in this range 85.20, 85.70 for days if that's what he wants to do. Completely different pair volatility wise. One more from me, then I'll hand it over to the Cayman. Dollar China, it's still looking strong, but again, it's not breaking up through the zones. It's moved up through this zone. Now we're going to see, I'm going to watch to see if it's going to hold this zone. If it breaks up through here, I'm going to, as I said before, I'm going to reassess what's left of my short from up at 736. But this China news, if they are starting to bring out some big guns, could mean we're going to be heading back down again. So for now, I'm just in wait and see mode on this one. Okay.
Yeah.
Time for
Yeah,
you
that's
to
what I
shine.
updated this morning as well in the room on the dollar China. And I think it's time, or it's getting slowly to be time to monitor what they are really doing and how dollar China is going to react in the upcoming days or even weeks. Because we're in this range, but as we've been saying many times, ranges are there to be broken at one stage. So I think it's going to be interesting because despite all their guns coming out to try and save the situation, if the Chinese yuan fails to find support at some stage, because let's not forget, they also regularly send out the submarines to sell dollar China, right?
Yeah.
If that fails to underpin dollar China, then we may start to look at the top side again in dollar CNH. If in turn investors start to buy the idea that they are saving their internal local economy, they're saving their stock market, etc., then all of a sudden, if we get foreign inflows into China, then we may be in for a break to the downside. I think it's time to start to just monitor things a little bit, the moves. I'm not saying that we have to enter a position now. People have. I've been reading a couple of articles. People have very different opinions about it, whether it's going to work or not. Some say we are going to 760 in dollar China, and others are saying that, well, it may be time just to start to look at China again. And in which case, then we're probably going to see the Chinese yuan strengthen. Perhaps not even so much against the dollar, perhaps going back to levels where we were back in 2023, around 670, which is in percentage terms, what is it, 4 or 5% move or so, which is already enough. But if you look at it comparing to other currencies, and then I'm thinking about some of those currencies like Japanese yen, for instance, we could be in for a bit of a revival of the Chinese renminbi against that one as well. But okay, still monitoring, but I haven't made up my mind yet on it.
Yeah, I think in the market size, it's still a case of talk is cheap. They keep talking and talking and talking. They keep messing around the edges. And as we said, they threaten the big bazooka, $280 billion or whatever it is, but we're yet to see how they're going to deploy that. As I said, maybe part of the ETF bite, but the market isn't quite ready to say, right, China are now putting the big guns to work, which is a dangerous position, because if they really want to smack it, they'll smack it, and they won't blink. And then that could be their stock market up 10% in a flash, and then everyone's chasing their ass to get out of shorts. But yeah, for the moment, the market's still saying, yeah, well, you're talking a good game, but we want to see some action. Yeah, still sitting on the fence. Finally coiled spring, this one. Right, over to you, mate.
Okay.
Oh, there we go.
Okay, just a quick look here, and which is also explaining, even if the dollar is beat, and I agree with the beat dollar, by the way, Annie. I'm positioned for a bit stronger dollar too. It's still not going too fast, because if you look at it, and I made a page of those major interest rate differentials, if you see the short-term euro dollar still in the box, you see the one that most are looking at, I understand, in the market. The sterling differentials, most are in the box, but we have broken ranges, as we were saying, on some of those currencies, so we need to respect it. For instance, on the cable, we broke this 125.90 figure now, as Ryan already showed. This is perhaps, we haven't seen a retest of it yet. It would be nice to get a retest and see what's happening there. But this is probably going to resist a bit now. 125.25 is the 38.2 of the a whole rally from October into the year end. So that's your first little level there, and the next one are those lows in December, which was the springboard to go higher into the year end. So 125 and a quarter, 125 for me. That's where we are going to have to monitor what's happening in sterling. If the dollar, sorry, continues to um, be strong, we could see a break and then go into those low 124s. I say if the dollar remains strong because personally, and that's just a personal feeling, I know the euro sterling is a bit higher. I know sterling yen is a bit lower, and sterling got hit a little bit. I was wondering yesterday what it had to do with, and perhaps it's just that thing that Iran used Lloyds and Santander UK to sponsor their less than clear financial operations. Could have been that the sterling got hit a little bit on that, but that's Harry hindsight stuff. But anyway, we'll have to look this 125 and a quarter, 125. All right. Yeah, euro sterling is well in the range, and that is already covered enough by Ryan earlier. Euro dollar, interesting here. The low in December, same kind of low as we had in the cable before we went up to do the last leg into year end, is now being challenged. All right. So the 61.8 here, if that breaks, I think we can see a bit lower. I'm positioned via options. I think there is a possibility, a fair possibility, just on the basis of those US data, the yields going up, but it may be a small grind, as I just showed in the differentials. The differentials are not supportive for big moves. The equity markets, neither. So it's really based on data and technical breaks. Okay. I think the for now that one and I was talking about it in the room yesterday, 107.65.75 is your first little resistance zone. We went up in the Asian time too close to that level. I think that was a combination of the Chinese trying to inject more dynamism in their equity markets, and the factor of the RBA. We all know that in the Asian time zone, there's a little bit less liquidity. So that may be the reason why we went for a retest, but we, I must say, miserably failed. And for the time being, the cap is not bouncing that much because we are trading around the lows anymore. I think for a reversal or a move back into those ranges, I'd say back above 107.95, 108, we are going, then I'll probably throw the towel in trading euro dollar for a good while, because I'm unless something really changed dramatically for the dollar, but if it comes in a natural way, I reckon we are going to see the vol even getting crushed more, and we could even range trade for longer, and those differentials not move at all for a long while. But hopefully not. Hopefully we can still get some volatility. I'm going to look at the Kiwi today because yesterday we dropped out of the daily cloud. We also dropped below the 200 DMA. We went to test the 100 DMA. We are actually trading around there. This is a pretty interesting zone to me on the Kiwi. Okay, if overnight it rallied, I think more out of sympathy with what's happening on the Aussie dollar than anything else. Well, the dollar was slightly weaker across the board as well, but we are not holding inside the cloud. I think this is this is good enough to monitor 60.70 up to 60.85. If you get closes below, it's likely that we could continue a bit lower. There are levels below. There's this 60, the figure is going to be not only psychological, but it is the 61.8 as well of this move that we had into year-end last year. So there are really decent levels in most of the dollar pairs. If we're going to get for those tests, those levels are not miles away. Okay, so these are going to be big test levels. Whether they they hold or be broken. That's that we will see once or if we get there. Yeah, there's one that that I'm keeping an eye on. The dollar mix is a bit doing the yo-yo, still staying above the 17 line. But we're seeing a bit of strength in the mix here overnight, and I think that has to do with the um, the 180 degrees that the GOP did in the US regarding the border and the Ukrainian aid package that they wanted to throw into one package, and then they themselves are on the friendly advice of Mr. Trump have thrown out of the window themselves. So perhaps a little bit less stress for those border people right here and now, and we are seeing the MEX has been strengthening overnight. But as I was showing here in the room, watch out, we're coming into support here. If Euro makes 1835-ish, we are on it, you know, we are on it. Would break and stay offered throughout the day. I think we can go back testing those lows into the 18s before rethinking the whole thing. Now, we have to be very careful with those political issues because they can fire back any day, right? But if you look at the really long term, this is the 2010 after the GFC and up to 2020, the pandemic scare in the euro makes. And look where the 78.6 lies of this whole 10-year move, okay? It is just below 18, the figure on the euro mix. And I would say keep a very, very, very close eye on for those who are trading emerging markets, if Euromex ever trades around 18, the big figure. What is that? Ali, you're 107.19. Yeah, 107.19. Of course, we can get there in the euro dollar. It's just above that 61.8. It's 13 pips away. That's one big flow and over and done with it. Of course, it can get there, I would say. On the Swiss, because I know quite a few people are trading and watching Swiss in our room. We are trying to break this trend line from also the year-end drop. It's clearer on the 4 hours, but I want to be on the daily because we are retesting the first rebound level that we had towards the end of January here. We are right on it, and we are testing the top end of the cloud. It's Swiss franc. It's not something that in normal times is really going extremely fast. This thing could take hours, if not days, to really break. But keep it in mind, if we start to close above 87 and a quarter, 87.30 on the dollar Swiss, we could be in for a retest of that bigger resistance zone, I would say, up in the high 87s, and still my magic level is still around that 88, 10.20 here. That was really when dollar Swiss took on the last leg lower of the year end, and before it was really holding very well and already trading. So this is still my magic level up there. But we will see whether it finally starts to break or getting capped again. And to finally break higher, we are going to need a bit of help of this one, I reckon. And this is still struggling around 93, 60, 70, the Euro Swiss. If we start to break up here, then I reckon your dollar Swiss is also going to be in for a bit of a bounce. And I've taken more than enough of your time. Back over to you, Ryan.
Yeah, thank you very much, mate. Thanks for all that wonderful insight as well. We'll call it a day for today. Thank you, guys and girls, for all your input. Ali, we do read all your comments. We may not get to all of them, but they're all read, or always open at the side of my screen here, so I get to know what you guys are all talking about. Thanks, everyone, for coming to the Flow Show. Enjoy your day. Have a safe trading day. Be good. Be safe. Thanks, Kate, and we'll see you all tomorrow.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.